Hey, how's it going, guys? Welcome back to the Module 5 of Technical Analysis Foundation, the complete professional trading course for beginners. Module 5 is all about building your own trading system. In this tutorial, we will go through one of the most classic and famous trading system examples called the Turtle system. After you learn the Turtle system, you will have a much deeper understanding about how a trading system works, so that it will help you to become more confident on building your own trading system. Alright, let's get started. I'm pretty sure some of you already heard about the Turtle system or the Turtle traders. For those who haven't, I will quickly go through some of the important background and stories behind the famous Turtle experiment. So, back in the 1980s, there was a very old but popular question that has been debated on Wall Street for a long time. Are top traders born or trained? And in 1983, two legendary traders, Richard Dennis and Bill Eckhart, decided to do an experiment to find out the answer. Richard Dennis believed that he could teach normal people to become great traders like him, while his partner Bill Eckhart insists great traders were born to win. So they decided to recruit and train some normal people, give them the actual accounts with real money, and then to trade and to see which one of them was correct. Out of thousands of applicants, they selected 13 of them for the experiment. They were invited to Chicago, trained by Richard Dennis for 2 weeks, and in December 1983, the students started the real trading with actual accounts with account size from $500,000 to $2 million. Richard Dennis named these 3 students the Turtles because he just returned from a trip to Singapore and was impressed by how the local Singaporeans grow the turtles. So that's how the Turtle experiment was born. In the experiment, every student was given exactly the same systematic mechanical trading plan called the Turtle system. Richard Dennis told his partner, "We're going to grow our student traders with a system, just like how they grow turtles in Singapore." And he was right. The Turtle experiment became one of the most successful projects in trading history. The average annual compound return among those turtle traders was astonishing more than 80%. Since the success of the experiment, the Turtle system became the hottest holy grail that every trader on Wall Street wanted to know. And yes, Richard Dennis proved to the world trading could be taught with a system. He proved that with a simple set of rules, he could take normal people with no trading experience and make them the top traders in the world. Jerry Parker is one of the most successful students among all the Turtle traders. In fact, he's currently running his own hedge fund. When people ask him about the success of Turtle traders, he mentioned about 2 things. First, the reason the Turtle traders are so successful because they trade with a systematic mechanical trading plan. They had a trading system. The trading system is what makes them successful. Second, they find ways to follow the system with high level of discipline. Just like he said during the interview recently, it's truly important to have a systematic way to approach your trading and stick to that system and follow it. In the last tutorial, we learned about the 6 key components of a complete trading system, and now we're going to deconstruct the entire Turtle system into 6 separate pieces, take a closer look at the details in each component, and find out what exactly makes this system so successful and so powerful. Maybe you can even use the same system for your own trading, especially for the beginners. First, the market. The Turtles were future traders, and they trade future contracts on the most popular US commodity exchanges. Because their average order size is quite big, that's why they only focus on the future markets with high liquidity. Volume and liquidity is something really important when you pick up the markets to focus on. So here are the major future markets that the Turtle traders focus on. I will not repeat all of the markets names one by one, but there's one thing I would like to highlight is that the Turtle traders are essentially trend followers with a trend following system, which means they need to focus on as many uncorrelated markets as they can to increase their chances to catch the big trend. Alright, next is the position sizing. The Turtle traders use a volatility-based position sizing strategy. This strategy can help to normalize the dollar volatility of a position by adjusting the position size based on the dollar volatility of the market. So pretty simply, when the market has a high volatility, the Turtles will have a smaller position size. When the market has a low volatility, they will have a bigger position size. The reason behind this strategy is that Richard Dennis wanted to make sure for any positions turtle traders have, they will move up or down in any given day at about the same amount in dollar terms when compared to other positions in the same portfolio, no matter the underlying volatility of the particular market is high or low. This will make traders' job way much easier, especially if you are a trend follower with many different uncorrelated markets in your portfolio, because the prices of those different markets, they may vary really hugely for the long run. When the volatility rapidly changes during a short period of time, this position sizing strategy also helps turtle traders to adjust their position size accordingly without changing the risk. Now, let's take a look at how exactly turtle traders calculate their position size step by step. Step 1. Calculate N, the underlying volatility of a particular market. Here, the N is simply the average value of the past 20 days market true range, which is called the average true range, or the ATR. We actually mentioned about the average true range in the previous tutorials before. Here's the calculation of the N, the 20-day average true range. I will not go to the details of these formulas because nowadays any charting software can easily plot ATR chart for you as an indicator. So you don't have to do all this tedious calculation anymore. Because back to the 1980s, they didn't have the powerful softwares to generate these powerful indicators for you to make your trading life way much easier. So nowadays, you can just use the ATR indicator like this one. So I just did a screenshot from the trading view so that can show you guys how the ATR indicator looks like in nowadays. But it's always great to understand the formulas behind the indicator. Alright, once we get the market volatility value N, we need to translate this market volatility into a dollar amount volatility. This will be the step 2, called the dollar volatility adjustment. If you are a future trader, like the turtle traders, you will know that in a future contract, for every point or tick, it can translate into a certain dollar amount. It's called a dollar per point. To calculate the dollar volatility is very simple. You just simply use N to multiply the dollars per point. Step 3 is to decide the maximum risk per trade. Here's the 1% rule that Turtle system adopted. 1N strictly represents 1% of the total capital risk. Step 4 is to calculate the unit size, and from the unit size to determine the position size. The turtles build positions in pieces, which they call the units. Each trade is a piece or 1 unit to the entire position. So to understand how turtle traders determine their position size, it's very important to understand the concept of units. Unit size was carefully calculated so that each unit will not risk more than 1% of the entire account capital. And this is the formula to calculate the unit size. 1% of the account divided by the dollar volatility. And the entire position size is the unit size multiplied by the numbers of units. The reason position size is so important in trading is because it's the key to risk management, and the Turtle's trading system uses units as a measure of risk. Even nowadays, this approach of risk management has been widely adopted by many traders. The concept of unit was not only used for calculating position size, since the unit size was volatility adjusted, it is also a great measure for risk of one single position to the portfolio and the risk of an entire portfolio was exposed to. The total traders were actually given the risk management rules that limit the numbers of units could hold at any given time on actually 4 different levels. I'm going to explain what are the 4 different levels are. The level 1, single market level. For any single market, the maximum size of position size is 4 units to the max. Level 2, the closely correlated market. If their markets are closely correlated with each other, then the maximum size for all the correlated positions together is 6 units. Level 3, loosely correlated market. If the positions are not correlated with each other closely, then the maximum size can be limited up to 10 units. Level 4, the last level, is to measure the trade direction risk. Basically, for all the long or short positions, the maximum size is 10 units for each direction. These are the position sizing rules for Turtle trading system. Apart from the risk management, money management is also a huge part in position sizing, especially when it comes down to adjusting account size and the trade size. Because after trading for a while, traders will encounter wins or losses, so the actual account size will have to adjust based on how much they gain or how much they lose. After large winning trades close out and realize the profits, turtle traders will increase the size of equity used to calculate the position size. Similarly, they will decrease the unit size after a series of losses. Turtle trading system adopted a special money management rule. It's called a 2-to-1 ratio rule. Basically, it means that, for example, whenever their account goes up or down X%, they will increase or decrease their notional account size by 2x% accordingly. If a turtle trader is trading a $1 million account and the account went down 10%, he would then begin to trade as if he had an $800,000 account until he recovered the losses. On the other hand, if a turtle is trading at a $1 million account and had a 10% gain, then he would begin to trade as if his actual account is 1.2 million. This rule helps the turtle traders to become more aggressive when they trade well and become more conservative when they don't trade very well. Alright, let's look at the component number 3, the entries. The turtle traders use two related breakout entry strategies, and they call them the System 1 and System 2. System 1 is a short-term system based on a 20-day breakout. System 2 is a long-term system based on a 55-day breakout. For turtle trading system, a breakout is defined as the price exceeding the high or low of a particular number of days. For example, a 20-day breakout would be defined as when the price exceeding the high or low of the past 20 days. Turtles always trade the breakouts at the same trading day. They didn't wait until the next trading day to pull on their trades. In the case of opening gaps, they enter the trade at the opening price, no matter what price will be. Alright, now let's take a look at the details of these two entry systems that the turtle traders use. System 1 entry. When the price exceeds the 20-day high, the turtles would buy 1 unit as a long position. When the price dropped below the 20-day low, then the turtles would sell 1 unit as short position. System 2. When the price exceeds the 50-day high, the turtles would buy 1 unit as a long position. When the price dropped below the 50-day low, then the turtles would sell 1 unit as short position. So these are the two entry rules that turtle system adopted. Adding units is a big part of the entry rules in any trading system, and it is also a crucial part of trade management. So this is how turtle system defines when and how many to add to the current existing positions. In the position sizing component, turtle traders will have the value of n, which indicates the underlying volatility of a particular market. They would enter 1 single unit at the entry, and then keep adding to that position whenever the price moves half of the n value. So I will give you an example. This is how it looks like. If the entry price is $100 and the value of n is 4, so 20-day average true range value is 4. Then, when the market moves up by $2, which is the half value of the n, the turtles would add 1 more unit. So they will repeat the same process until the position reaches the maximum limit, which is 4 units. Turtle traders were taught that they need to be extremely consistent in following the entry rules and taking the trades with no emotions, because most of the profits in a given year could come from only 3 or 4 large winning trades. If one entry was missed, this might greatly affect the total return for the entire year. Alright, component number 4, stops or the stop loss. This is a component that tells the turtle traders when to get out of a losing trade. Short-term average volatility is the factor that helps turtles to determine when and where they set their stop loss. Therefore, the turtle system uses n-based stops to align with the short-term market volatility, the average true range, like the position sizing. Turtle traders set the initial stop loss 2n away from the entry price. This will give enough room for each position to fluctuate and develop the maximum profits potential. Because turtle trading system is essentially a trend following system, so trailing stops are necessary. Whenever a new unit was adding the current position, the previous unit stops need to be moved up for the long positions and moved down for the short positions by the value of half n. Instead of entering an actual stop order placed with the broker as the stop loss, turtle traders always use the mental stop for their stop settings. Mental stops are especially important if you trade a large size and you don't want your brokers to know where your stop losses are. These stop losses are non-negotiable. If a particular trade hit a stop loss, then the total traders will get out of the position with no exception. Let's take a look at one simple example. For a long trade, the entry price $100, the value of N is 4. So the initial stop loss is set to at $92, which is 2N away from the entry price. Because it's a long trade, so the stop loss should be below the entry price. Once the price moves up by $2, which is half N value, then add the second unit, and the stop loss will move up by $2 as well. Repeat the same process for the third unit. When the third unit added to the position at the price of 104, the stop loss will move up to 96. This is how the total system set their stop loss and doing the trailing stop loss. Next, component number 5, the exit, which defines when to take profits from a winning trade. There's an old saying, you can never go broke by taking a profit. However, the total traders would not agree with it. Getting out of a winning position too early is the biggest mistake when trading a trend-following system. The total system enters on a breakout, and we all know that most of the breakouts fail. So that means most of the trades that turtle traders made will result in small losses. If the winning trades did not earn enough on average to offset all those small losses, the turtles will lose money. Where the turtle traders take profit can make a significant difference between a winning and a losing year in the end. So here's how turtles exit their winning trades. For System 1, they exit their winning trade and take profit at a 10-day low for the long trades, and they take profits at the 10-day high for the short trades. For System 2, they exit their winning trades at the 20-day low for the long trades, and they exit at the 20-day high for the short trades. These two exit strategies work hand in hand with the two entry strategies which I mentioned earlier. Alright, now we come to the last component of the turtle trading system, component 6, the rules. There are 7 trading rules that the Richard Dennis strictly set for the turtle traders. Well, some of them were already mentioned when we talk about the first 5 components, but right now I'm gonna compile them together and then share with you one by one. Number 1, risk management rule. The turtles are not allowed to enter too many trades and they risk more than 20% of the total account equity. Number 2, money management rule. Whenever after realizing big winning trades or a series of losses, the turtles must adjust the notional account size accordingly for the future position size calculation. The ratio is strictly 2 to 1. For example, the turtle traders have to decrease the size of the notional account by 20% each time if their original account went down 10%. Number 3, trade management rule. After initiating the first unit on the position, continuing adding one single unit to the same position every time when the market moves up half value of N to the right direction until the position reaches 4 units. Number 4, buy strength and sell weakness. If the entry signals all come at once, turtles always buy the strongest markets and sell the weakest market in a group. Number 5, never use market order. Turtles were strictly not allowed to use market order. They only use limit order and learn how to get filled smartly with limit orders. Number 6, never chase the fast market. Sometimes the market moves very quickly and the turtles' limited orders won't get filled. The feeling of FOMO will kick in. FOMO means fear of missing out. During the fast market conditions, traders were advised not to panic, wait for the market to stabilize, and then assess the market again. Number 7, do not take premature profits. This is probably the most important rule. Waiting for a 10 or 20-day new low to come can often mean watching a 40% profits vanishing right in front of your eyes. This is very harsh because there's a very strong tendency that you want to exit the trade early. The ability to maintain discipline and stick to the rules is the most underrated key to the huge success of turtle traders. Alright, here you have it, the 6 components of a complete turtle trading system. This was exactly the system that Richard Dennis provided to the turtle traders and make them millions of dollars for each one of them. On the very first day of turtle training program, Richard Dennis told all of them, trading decisions should always be made as unemotionally as possible. That's why making your trading decisions and activities as systematic as possible is the most essential job that every trader should invest the most efforts on. Cool, we come to the end of the entire Module 5. Hope you guys enjoying it, and most importantly, hope you guys learn something valuable on building your own trading system. Thanks so much for watching, and I will see you guys in the Module 6. Bye for now.